Okay. Good morning, everyone. I welcome you back to this live virtual session on security evaluation, which is a chapter of advanced financial management pertaining to paper 2 of CA Final. In the previous class, we had started the discussion about uh, what was about the bond valuation aspect. So we discussed how to carry out the valuation of a bond by simply taking present value of all future cash flows. Then we also discussed how do we go about uh, you know, calculating the Macaulay duration. Macaulay duration, which was essentially only the weighted average of time period for an investment in a bond. And then we went ahead with modified duration. Modified duration was a measure of sensitivity of bond value with respect to YTM. Sensitivity of bond value with respect to YTM, or it was simply telling us that for every 1% change in the YTM, how much will be the percentage change in the bond value? And that was calculated as simply Macaulay duration divided by 1 plus YTM. So we computed that as 4.3 times, but when we actually tried to apply it, that let us see what is the bond value if there is a change in the YTM, then we observed that there was some small error. And when I change the percentage change of YTM to a larger percentage, like let's say 4%, so we initially changed from 5 to 6. This became 107, or there was an error of 0.1. We initially thought it might be due to some rounding of error. So we just thought of checking a higher percentage change. And that's actually 1.96. So we were just thinking why this error is coming in our estimation. And then we just started looking at the curve of bond value with respect to the YTM number. And what we observed in our calculation is as the bond value or as the YTM is increasing, the bond value reduces. But that reduction in bond value is essentially not in a straight line format. It's not in a straight line format, it's a curve. If it's a typical curve, because of that, we are actually having an error in our estimation. So how is that error coming in? Let's try to understand it. See, initially we were at what? 5%, and then from 5 to 6, and then we also saw it up to 9%. Okay. So right now, let me just help you to understand this with the help of another graph. What we have observed is there is a curve which is happening when it comes to bond value with respect to YTM. Right? So there is a curve which is happening. So now suppose this is the YTM of 5%. This is 6%. This 7, 8%, and 9%. So when we actually calculated the modified duration, we got certain number. And you know what? That modified duration is essentially uh, a straight line which we draw over this curve. We have a straight line. So essentially we can say from 5% And here, if I just draw a dotted line upside to check where my bond value is. So bond value is typically over here. Here it is. This is a typical curve or typical line that we drew. And this line was actually representing the modified duration of, what was the modified duration? 4.3. Sorry, my color, yeah, modified duration is 4.3. This was representing a modified duration of 4.3. And what we observe is, as we change the YTM from 5 to 6%, the new bond value that we observe as per modified duration, it is this. But your actual bond value is over here. So do we see some gap between the price estimated by modified duration? Do we see any sort of gap between the price quoted by modified duration and that which is observed by the actual market price? There is some error, right? This was modified duration of 4.1, 4.3, sorry. Right? So can we see that there is some sort of an error which is between coming in between the actual bond value and the estimated bond value, which is over here. You can see this area. There's this area, right? There's a gap over here, right? So this gap is the reason you will find that there is an error. So this gap was actually representing the uh, error that we have, this one. This was representing the error of initially 0.1. Okay. This is essentially representing an error of 0.1. And as you move ahead, you can see the error is actually quite widening enough, right? As you move ahead, you can see that the error keeps on increasing, right? So this error, we can say it is primarily due to that curvature effect of the bond. Okay. So same way over here, if we just draw a straight line over here, you can see there's always a curvature effect which is happening. As you move across the graph, you can see over here the error keeps on widening. And that's the reason we are observing this typical error in our estimation. So can we say that the modified duration as a measure is complete enough to tell us the actual change in the bond value that is happening? Is the modified duration complete enough to tell me or complete enough to guide me with the actual change that's happening in the bond value? Is it complete enough? Or do we need to have some other measure also? Yeah, tell me guys. You feel that the modified duration that we computed Is it complete enough? No, there is some error which is creeping in. And why is that error, guys? Why are we having that error? Why are we having that error? Hence, that error uh, is due to this curvature, right? The error is due to the curvature that is there in the actual bond value curve. Had the bond value been a straight line, like see this curvature effect, the bond value is a curve. So had the bond value been a straight line like this, then we wouldn't have faced that issue. Had the bond value been a straight line like this, then we wouldn't have seen this error coming in. So can I say that error in our estimation is due to the curvature of the bond, right? Error in our estimation is due to the curvature in the bond. So I need to address that part. I need to address that part, which is essentially the curve effect. Okay. So that curve effect is what we call as the convexity. That curve effect is what we call as the convexity of the bond. Okay. So convexity is the curvature effect of bond on its price. Convexity is curvature effect of bond on its price. Convexity is simply going to be curvature effect of bond on its price. Now, how do we measure that convexity and how do we bring into our calculation? Like we said, the percentage change in bond value was percentage change in YTM multiplied by percentage change in YTM multiplied by the percentage change in YTM multiplied by modified duration. But I just need to make it a complete thing where I can say improve percentage change in bond value, or instead of saying this is our estimated percentage change in bond value is this. And so we can say improved estimated percentage change in bond value will be calculated as percentage change in YTM multiplied by modified duration. Percentage change in YTM multiplied by modified duration plus we will have a convexity effect or convexity correction. The percentage change in YTM multiplied by modified duration plus convexity correction. Okay. So improved percentage change in bond value is percentage change in YTM into modified duration plus convexity correction. So that convexity correction will be added to it so that we are able to remove the error in it. Right. So for that, I need to calculate the convexity part. Now let me just say that this is going to be percentage change into YTM, percentage in YTM into modified duration. plus we add the convexity correction is defined as half into convexity. So we'll be calculating a convexity number, half into convexity into percentage change in YTM square. So improved percentage change in bond value is going to be calculated like this. So once we calculate this, we will observe that the error that we were keeping in, error is actually eliminated to a great extent. Okay. So the next part is obviously how do we calculate the uh, percentage change in bond value by looking at the convexity. So we need to first look at how to compute the convexity rates. Right. So just as we computed modified duration, I need to compute a term called as convexity. Okay. Now what's the formula for convexity? Because we need to capture the let me say the curvature effect. Okay. That curvature effect is going to be estimated. So convexity is calculated by taking summation of EV into T into T plus 1. The T is denoting the time. EV into T into T plus 1 divided by bond value multiplied by 1 plus YTM square. This is the formula for convexity. Now, if you tell me how is this formula derived, of course, I will not be able to justify that to you because you will not understand what is that in essence. This convexity is going to reflect the curvature, and I can say this is also going to be said as the second order derivative of bond value. Remember, modified duration was the first order derivative. This is the second order derivative of bond value. So I can say this is like derivative of bond value with respect to YTM, right? Or you can also say this is derivative of modified duration. This is essentially derivative of modified duration. Derivative of modified duration. You can say convexity is what? Once you have computed first order derivative, like first differentiation from bond value to modified duration. Then you have from modified duration to convexity as a second order derivative. And when we will actually use this formula and put it in our estimation, what we will find is the error that we were getting that is actually almost eliminated. It's actually almost eliminated if you look at it. Okay. So let us try to calculate the convexity in our case in this formula. Like we have this present value given to us. Okay. Now what I need is PV into T into T plus 1. PV into T plus 1. So that is PV into T into T plus 1. Because that's the first part in our, we have in the numerator, right? Summation, we want the summation of PV into T plus 1. So I'm just adding this column and we get these numbers. We're getting this convexity, I mean, numerator for our formula. So let's try to get the convexity. So convexity is summation of PV into T into T plus 1. And then you divide by bond value into 1 plus YTM square. Just substitute the values. PV into T plus 1 will be this. Bond value is this. And 1 plus YTM. Current YTM is anyways what? 5%. You just substitute in this and give me the convexity value, guys. Give me the value of convexity. Give me the value of convexity. Yeah, what's the answer is? Convexity, value of convexity. So in numerator, it will be this 2931.67. Denominator, it will be 112.16 multiplied by 1.05 raised to 2. Yeah. This divided by 2 multiplied by 1.05 raised to 2. That's 23.7072. Okay. 23.7072. We have this as what? 23.7072 as the convexity. Convexity is 23.7072. So now when we are looking at percentage change in bond value for 1% change in YTM. For 1% change in YTM, then it will be modified duration into 1%. In fact, this is going to be like minus thing because the percentage change is going to be negative. Minus modified duration into 1%, which is the percentage change in the YTM, plus 0.5 into 23.7072, half into convexity into 1% square, half into convexity into percentage change in YTM square. So modified duration into 1% plus half into convexity into percentage change in YTM square, because that is what we have discussed over here. Half into convexity into percentage change in YTM. So let's try to get the percentage change. This is modified duration was what? 4.1, right? Modified duration was 4.3 times. Sorry. Modified duration was 4.3 multiplied by 1% plus 0.5 into 23.7072 multiplied by 1% square. So this is going to work out as minus 4.3 into 1%, which is 0.01 essentially, okay, plus 0.5 into 23.7072 into 1% square. What we find as a percentage change, after making for the correction, after making for this section is actually your convexity adjustment or convexity correction. So after making this convexity correction, we're getting the percentage change in bond value to be 4.18% negative, right? So what will be the revised bond value? You can say revised bond value will be the original bond value, which is 112.16 multiplied by original bond value was this, and it is going to change by this percentage. So it's going to minus 4.18% into 112.16. This is 112.16, the original bond value, minus 4.18%. Total change is 4.18% into 112.16. What we find the bond value to is 107.48. So bond value is going to fall to 107.48. And if you look at the actual bond value change, now you can see the calculation bond value to YTM of 6%. It is what? 107.44. It's 107.44, or actually we can say, see over here, this one 107.47, and we got it as 107.48. It is like a slightly 1 paisa, but that could be due to rounding off error. Let's try to test it for a greater change. Let us say percentage change in bond value for 4% change in YTM. For a 4% change in YTM, can you do the same calculations, guys? First, get this percentage change in YTM and then get the revised bond value. If there is a 4% change in YTM, then what's going to be the impact in the percentage change in bond value? Get this percentage change in bond value for 4%. Well, the formula over here, it will be similar, but instead of 1%, now it will be 4%. Yeah. So give me the percentage change that we are expecting if for a 4% change in YTM. The calculation will be now modified duration into 4% plus 0.5 into 23.7 into 4% square. Yeah. So what is this percentage change, guys? Tell me. What is this percentage change that we can expect? Yes, expected change is how much? This will be 4.3 multiplied by 4% plus half into 23.7072 into 4% square. This is what? 15.3% minus 4.3 into 4% plus half into 23.7072 into 4% square. Yeah, it's 15.3%. How come you're getting 19? Okay, do one thing. Try it out like this. See, because in calculator, if you type 4, it will give you some different number. Just make it like instead of 4%, make it 0.04. And even over here, make it 0.04 square. Try to solve with this percentage or with these expression and see if you're getting 15.3%. Yeah, 15.3%. Okay. So what will be the revised bond value? What's going to be the revised bond value is? That's 112.16 minus 15.3% multiplied by 112.16. That comes out to be what? Approximately 95. So let's check at 9%, what is the bond value? See, at 9%, we are having the bond value as 94.83. 94.83. Earlier, we had an error of 1.96. We had an error of 1.96. And the actual value that we observe over here is 94.8. So we still have an error, right? We still have an error, but the error has been reduced to drastically, 17 paise or 0.17. So the error is now it has now reduced to 0.17. Okay. So remember, even after using convexity, are we getting a perfect answer? No. And that's the reason I just said over here in our discussion that this is an improved estimate. This is not an accurate value. We're still going to have some sort of error. Okay. So I'm just going to teach you some amount of physics now, just to give an idea why we are having error. In physics, there is a expression called as Taylor series. Okay. In the Taylor series, whenever you want to see a percentage change in y, whatever is a percentage change in y, that's actually calculated as initially percentage change in x multiplied by dy by dx This is exactly what we did as modified duration into percentage change in YTM. Okay. But this is just a very crude or a very rough estimate. To make it accurate, we just add half into percentage change in X square into D square Y by dx square. This is essentially half into modified duration into percentage change in YTM. Okay. That's your percentage change in Y with an improved thing. But even in this, you will have some sort of error. If you want to improve it, just add one more term, 1 upon 3 factorial into percentage change in X square multiplied by d cube Y by dx plus 1 by 4 factorial into percentage change in X square into d raised to 4y upon dx raised to 4. If you want to improve it further, add 1 upon 5 factorial, sorry, cube raised to 4, 1 upon 5 factorial into percentage change in x raised to 5 into fifth derivative of y. So you can just keep on adding terms to it to get an even more estimate, even more accurate estimate. But for us in finance, we are just stopping at the second order derivative because that much is sufficient for our calculation. Rest all things, when you want to launch a rocket or when you want to launch a satellite, where even a small deviation in the path can cause your vehicle to move to Mars instead of Moon. So there we use, higher order derivative. But right now for us, only this much is sufficient. Okay, so we are stopping at the second order derivative, not moving to the third order derivative. Okay, did we get it, everyone? Are we clear? We clear, everyone? Okay, so therefore we are just stopping at the second order derivative. We still have an error. Now, just to give you a glance of how the curves would be actually looking, the actual curve, the bond value with modified duration and everything, let me just show you a curve, just to give you an idea about what I'm talking of. Okay, this is the curve that I was trying to explain you. The blue line that you observe, the blue curve, that's the actual bond value. The price estimate which modified duration gives us, that's just orange line. And after adjusting modified duration as well as convexity, the curve that we get is the gray line. So can you see, for larger change in YTM, there is definitely a gap coming in. So convexity is able to adjust it to some extent, but beyond a point, it again starts to give some more error. And as I said, if you want to remove this error, you will have to take third order, fourth order, and fifth order derivative, which we don't want because on any particular point of time, the change in the rate of interest, it's not going to be more than 2% or 1%. Have you ever heard, I mean, what's the maximum change that you observe when there is an announcement by RBI regarding repo rate? How much do you see the change? What proportion is the change happening? What proportion is the change happening? What proportion or what percentage does the RBI change its repo or reverse repo or the reference rates? 0.25%, 0.5%, and 1% is like a very rare situation where you find that, economy is, something is very urgent in the economy. Then only 1% or more than that is expected. But for all practical purpose, we can see that percentage change in YTM actually settles for just zero point 0.5 or maybe zero point 0.3 or 0.25%. Got it, everyone? Everyone got it? Okay. Now, once we have uh, we have seen how the calculation for convexity and everything is done. Let's do a couple of questions now. Yeah. I have this question number 24 is. Question 24, we have to get the current market price, duration, and volatility. Remember, duration means we're talking of Macaulay duration. Volatility means we're talking of modified duration. Okay. So with these parameters, try to get the Macaulay duration and modified duration for this, and also expected market price if increases, I mean, if increase in required yield is by 75 basis. So that will be like the expected change, and then after expected change, you calculate the expected price. Try to solve this. After that, we have to do quite a few number of questions ahead. So as far as this is concerned, we have the face value. Face value is 1000. Then you have the coupon rate. Coupon rate is 16%. Years to maturity. Years to maturity is 6. And we have the redemption value and YTM. Yield to maturity is 17%. Of course, maturing at face value itself. You have to get the duration, volatility, and the market price. So just as we did in the previous case, take the year, cash flows, PV factor at the rate of 17%. Then we have PV. So year 1, 2, 3, 4, 5, 6. Cash flows are going to be coupon rate, which is 160. Then write on the PV factors, write on the PV, add it up. Take the total. Then for modified duration, you need to do PV into T, then calculate the modified duration. Modified duration is sum of PV into T divided by 1 plus YT. You know, that was my Macaulay duration. When you say modified duration is Macaulay duration. In fact, this is summation of PV into T into summation of PV. And modified duration is Macaulay duration divided by 1 plus YT. Get this Macaulay and modified duration. Yes. Get the value of Macaulay duration and modified duration. You can see that one value is what 964.11. Okay. To get the MACD and the modified duration number. Try to get the Macaulay duration and modified duration number. Yeah, so this is going to be PV into time period. Estimated percentage change in bond value will be 0.75%, or this is going to be like minus modified duration into percentage change in YT. So this is essentially going to be minus modified duration, which is 3.63 into 0.75%. 3.63 into 75%. That's minus 2.72. Minus 2.7. That's the percentage change in the bond value. So what will be the revised bond value? Revised bond value will be minus 2.72% into, or it is going to be like original bond value, which is 964.11. This multiplied by 1.0272. Or wait, 1 minus 0.72% is subtracted because there's a negative change, right? There will be 964.11 into 1 minus is 2.72. So the revised price is 937.86. Grom is asking, Macaulay duration is a weighted average time period when investor received his principal and interest of his initial investment. Yes, you can say that. It's a weighted average time period, correct? Okay, 937.86. That's the revised bond value. Okay, so that's question 24. Now, let's go ahead with another interesting aspect called as bond immunization. Okay, it's a very interesting concept of bond immunization. Let's try to understand this. We're looking at bond immunization concept. It's a very interesting concept that we are looking at over here. Um, Now, let us say we are investing in a bond with a tenure of 2 years. Okay. So suppose we have a bond with face value being 100, coupon being 10%, YTM, the market rate of interest is, let's say, 12%, and tenure is 2 years. Okay. So now, of course, what will be the value of this bond? Can you tell me what will be the value of this bond? What will be the value of the bond today? What will be the value of this bond? You can simply say it is 10 multiplied by present value annuity factor at 12% for 2 years plus 100, which is a face value, into present value factor at 12% for 2 years. So give me the value of this one. That's what 96.62. So today, if you are going to invest in this bond, 96.62, you're going to buy the bond at this price, 96.62, right? And the tenure of the bond is 2 years. So we have year 0, year 1, and year 2. So today you invest 96.62, right? And you receive coupon of 10 in the first year, and you receive a coupon of 10 and the face value, which is 110 in the second year, right? So now my question is, how much is going to be your accumulated value at the end of second year? How much is going to be your accumulated value at the end of year 2? By the end of year 2, what will be the accumulated value? 120. So are you assuming that this 10 rupee will not be invested for one more year? Are you assuming that this 10 rupee will not be invested at the end of 1 year? I mean, are you not going to reinvest it for 1 year? Yes or no? Are you saying that this is not going to be reinvested? So it will be reinvested, right? So the accumulated value is actually dependent on what is? This accumulated value is actually dependent on what? It actually depends on the rate at which this is going to be reinvested, right? So the rate at which this is going to be reinvested, that is what it is going to be dependent on. Final value is going to be dependent on that part, right? So accumulated value at the end of year 2 will be dependent on the reinvestment rate, which is the R over here. Okay. Now, accumulated value, by assuming, let's say the reinvestment rate is the ongoing YTM itself, which is 12%. Let us say the reinvestment rate is same as what we have as the accumulated value. So we can say R, let's assume that R is same as the current ongoing YTM. So if I assume that R is same as 12%, R is same as 12%, then accumulated value at the end of year 2 will be, of course, original 110 plus this 10 reinvested at 12%. What will be the accumulated value? What's going to be the accumulated value is 110 plus 10 into 1.12. That's going to be 121.20. But are you really sure that you will be able to reinvest your money at the same YTM rate? Yes. Are you sure that you will be able to reinvest at the same rate? No, because current ongoing rate over here is 12%. And after 1 year, we really don't know what's going to be the rate. After 1 year, we really don't know what's going to be the rate. So accumulated value at the end of year two, it highly depends on this rate. Right? So let us say what will be the accumulated value at the end of year two if we are saying, let's say the R is only 4%. Reinvestment opportunity available for you. If it is just 4%, then that. Then can I say it will be 110 plus that 10 reinvested at 4%. What will be this value? 120.4. So even after investing in a fixed income instrument, even after investing in a fixed income instrument, what we find is that essentially uh, we are not having a surety about what will be the accumulated value. Now, this was a simple case of 2 year bond. Had it been a case of 10 year or 8 year bond, then the difference would have been significantly large. Right? So had it been, there has been some other bond, then this difference would have been significantly large case. Okay, so to tackle that aspect now, to tackle that particular aspect, we can say it's 121.2 and 120.4. These are the two respective values that we have for the different YTM rates. Now we are looking at a technique, we are looking at a strategy, wherein whether the whatever be the reinvestment rate, we will still be able to realize a fixed value. We will still be able to realize a fixed value, and that is essentially what we call as a bond immunization. So, in bond immunization, what we say is we don't invest in a 2 year bond. We don't invest in a 2 year bond if our target time period of investment is 2 years. So if you want the money in 2 years, don't invest in a 2 year bond. Okay, so bond immunization says don't invest in a 2 year bond if you want the money in 2 years. Because there you are definitely having this sort of uncertainty. So how do we tackle with this guys then? Then this thing can actually be tackled by simply saying, uh, the accumulated value at the end of year two is going to be a varying term. So we are going to look at it from a different perspective. And that perspective is essentially going to be, bond immunization. So in bond immunization, we invest in a bond with duration equal to target time period of investment. Target time period of investment. So this simply means that if your target time period is 2 years, invest in a bond with duration. Now remember, when we talk of duration over here, we are talking of Macaulay duration. So invest in a bond with a Macaulay duration of time period equal to your target. So don't invest in a bond with a maturity of 2 years. Rather, invest in a bond with a Macaulay duration of 2 years. Okay. So if you don't have that bond, so it's quite possible that you may not have a bond exactly having this, Macaulay duration as 2. Rather, what you should do is, or you can say, invest in a portfolio of bonds. Invest in a portfolio of bonds with portfolio duration. Invest in a portfolio of bonds with portfolio duration equal to target time period of investment. So instead of investing in a single bond with a maturity of 2 years, you invest in a bond which is having a modified duration of 2 years. If that is still not there, then you can actually invest in a portfolio of bonds. Okay. You can invest in a portfolio of bonds which will have a weighted average portfolio duration as 2 years. Okay. Let's try to understand this with the help of an example as to how this strategy is going to help us to be having certainty. Like over here, do we all agree that these two numbers, they're not identical? And depending on the reinvestment rate, we can get different value at the maturity. Right? Now we are looking at a strategy which will give us exactly same value at the time of maturity as the reinvestment rate will be higher or lower. Okay. So let's try to do this with the help of an example that we have. Yeah. This is what we have. Question number 25. So this guy A needs 1 lakh after 2 years. Which value we want? We want a fixed value. Whatever be the value be the fixed. Like if the reinvestment rate is 12%, still I should be able to realize a value. And even if the rate falls to 4%, still I'll be able to realize a same amount of value. Because our concern is variation in the value, right? The value may reduce. We don't want that thing to happen. We want a certainty. So for that certainty, we are having this bond immunization strategy. Okay. Like for example, see in this Mr. A requires 1 lakh after 2 years. Mr. A requires 1 lakh after 2 years, for which he wants to make one-time necessary investment now. You can see he is very certain how much money he needs after 2 years. If he buys just one bond and reinvests the money, the reinvestment rate is going to essentially determine whether you're going to get a higher value or a lower value. Right? So our target is to get 1 lakh in 2 years' time. And now we are making a one-time necessary investment. He has a choice of two types of bond. Their details are as follows. So bond X, it's 1000. Coupon is 7% payable annually. Years to maturity is 1. Current price and current yield is given. We need to advise Mr. A whether he should invest all his money in one type of bond or he should buy both bonds, and if so, in what quantity. Assume that there will not be any call risk or default risk. Assume that there is no call risk or default risk. Call risk, basically, the bond is not going to redeem before due date, and also the bond is not going to default. Now, the first step is to calculate modified duration for both these bonds. Can we calculate the modified duration for both these bonds, Grace? Can you give me the modified duration number for both bond X and bond Y? Yes, everyone? Can you calculate the modified duration? Yes, Guram. Can you calculate it? Aditi, Sai Kiran, yeah, please. Go ahead and give me the modified duration for both bond X and bond Y. Okay. So what we have these numbers as Macaulay duration. For first bond, it is 1. Macaulay duration for the second bond, it is 3.56. Okay. So we have the number of Macaulay duration of bond X is 1 and Macaulay duration of bond Y is 2. Right? Now, as per the strategy, we are going to invest in a portfolio of bonds with portfolio duration equal to target time period of investment. Now, target time period of investment, so this is what 3.56. 3.5617. Okay, 3.5617. This is the value of Macaulay duration. So we have the Macaulay duration of bond X and Macaulay duration of bond Y. We have 1 and 3.5617. Now, as per our strategy, we said that we're going to invest in a portfolio of bonds with portfolio duration equal to target time period of investment. Okay. So with regards to target time period of investment, we would definitely say that target time period is, in our case, is 2 years. Target time period of investment is 2 years. Okay. So with this targeted time period of investment of 2 years, we can definitely say that investment that's required, I mean the weightage that's required, that needs to be completed. So let us say the weightage. You say let X be the weightage, right? So we'll simply say weight of bond X into Macaulay duration of bond X plus weight of bond Y into Macaulay duration of bond Y should be equal to 2. So weight of bond X into Macaulay duration is 1. And we can say weight of bond Y is 1 minus weight of X into 3.5617. This is equal to 2. So this is simply going to be weight of X plus 3.5617 minus 3.5617 into weight of X is equal to 2. Just solve this and give me the value of weightage of bond X. Solve this and give me the value of weightage of bond X, guys. Solve this and provide me the weightage of bond X. Solve this equation and give me the weightage of bond X. 4 decimals. Yeah, how much is the weightage of X? 0.6096. Okay. So once we have the weightage of X, we can actually get the weightage of Y also. The weightage of Y will be 0.3904. Okay. This is the amount of, the weightage of investment that I'm going to take. Now, understand what is the required maturity? How much maturity is required in 2 years? What is the amount that we need at the end of 2 years? At the end of 2 years, what is the amount that we need? You can say it is 1 lakh, right? We'll need 1 lakh after 2 years. So the required amount in 2 years is 1 lakh. So how much investment should be made now? Investment to be made now. What is the investment that will be made now? It's going to be 1 lakh divided by 1 lakh divided by, can I say ongoing YTM? What is the ongoing YTM rate? Ongoing YTM rate is how much? Current yield is how much? At 10%, right? So currently the yield is 10%. It's going to be 1.1 square, which is the present value of 1 lakh. So how much is the present value of investment that we should be making today? Present value of investment that should be making today, 1 lakh divided by 1.1 square. Yeah, what is this present value? If 1 lakh is the maturity value required on a future date, what is the value that's needed today? This is 82 point or 82,645. 82,645. This is the investment to be made today. Now, this we need to divide between X and Y. So investment in bond X will be 82,645 divided, oh, sorry, this multiplied by 0.6096 and invest in bond Y. How much should we be investing in bond Y? That will be 82,645 into 0.3904. Yeah, investment in bond X and investment in bond Y. How much is the amount? What amount are we investing in bond X and what amount are we investing in bond Y? Bond X, it is what? 50,380. Okay. What about bond Y? Bond Y will be what? 32,000 something. Investment in bond Y is how much? 32,000. Investment in bond Y will be 32,000 to 245. 2,245. No, 265. Yes. 32,265. This is the investment that we are making. Now the question is number of bond X to be purchased and what is the number of bond Y to be purchased. The number of bond X to be purchased and the number of bond Y to be purchased. So for that, we'll say bond X is totally valued of 50,380. That needs to be divided by 50,380 needs to be divided by number of bond X to be purchased 50,380 divided by the price of the bond. So what was the price of bond X? Price or the value of bond X? You might have computed, guys, total of all PVs. What is the price of bond X? Tell me. 972.73. Okay. That's 972.73. So this comes out to be how many bonds? You can definitely keep decimals in the bond, assuming that fraction investment is allowed. 50,380 divided by 972.73 is 51.79 bonds. And number of bond Y to be purchased is 32,265 divided by what's the bond Y value? Value of Y bond 936.52. Okay, so that gives us the number of bonds as what? 34.45 and 36 divided by 32,265 divided by 936.52. 34.45. Yes. We have 34.45. Now, let us say by the time of maturity, the original YTM which we had in the question, the original YTM was what? 10%. Let us say the YTM changes to 9% because our concern is if YTM reduces, then we will not be able to get the full value. So suppose YTM changes to 9%. Suppose YTM changes to 9%. Now, if YTM is changing to 9%, since we have one of the bond maturing in, like bond X, when is the bond X going to mature? When is bond X going to mature, guys? In which year? Bond X is going to be matured in which year? First year, right? If YTM changes to 9%, what will be the cash flow in year one? Cash flow in year one will be, can I say, 1000 redemption plus 70, uh, the last coupon, right? Yeah. So cash flow in year one is going to be 1070. Now tell me, at what rate am I going to reinvest it? This is going to be reinvested at, let's say, 9%. Reinvested at 9%. So value from reinvestment of one bond will be 1070 into 1.09. So how much are we going to get from this one bond? The cash flow in year one from bond X. From bond X, because we are going to reinvest it for another 1 year, because we want the maturity in second year, right? We want the money in second year. So value from reinvestment of one bond X, from one bond X, how much is this going to be? 1070 into 1.09. So this is going to be 1166.3. So with regards to bond X, what has happened? We are in year 0, 1, and then 2. So here you purchased at a price of 972.70. You received 1000 plus you received also 70. So this entire 1070 was reinvested at 9%, and that matures at 1166.3. So I hope you are clear with this part. 1166.3 being the value of your bond X, which you realize at the end of second year if the reinvestment rate is now 9%. Are we clear, everyone, with this? Yes. Are we clear with this part? Yes. Now let us see what happens with bond Y. What was the tenure of bond Y? What was the tenure of bond Y? What was the tenure of bond Y, guys? Tenure was 4 years. So of course, if I want the money in second year, how do I get the money from this bond in second year? How will I get the money of the bond in the second year? How am I going to get the money in the bond in the second year, guys? Hence, I'll have to sell the bond early in the market. I'll have to sell the bond early in the market, right? So from this bond Y, we're going to receive cash flow in year one. How much? What is the amount of cash flow? Because the coupon rate is 8%. Since the coupon rate is 8%, it is going to be 80. And this is going to be reinvested for 1 year at the rate of 9%. So whatever money you received in first year in the form of coupon, you're going to reinvest it in for 1 year at 9%. So reinvestment value will be 80 into 1.09. The coupon that you received and you reinvested at 9%. So what's the maturity value? 80 into 1.09, which is 87.2. 80 into 1.09, That's 87.2. Also, can you tell me what will be the sale value of bond Y in year two? Now tell me by the end of year two, the bond which was having a tenure originally of 4 years, what will be the remaining tenure? What will be the remaining tenure in year two? Can you see the bond which was originally 4 years? After 2 years, the tenure is going to be how much? After 2 years, the tenure is going to be how much? Remaining tenure is 2 years. So I can get the sale value of this bond by simply taking present value of future cash flows. So future cash flows are what? 80 into present value annuity factor at 9% for 2 years plus also 1000 into present value factor. Okay. So give me the tenure of this 2-year bond. This bond, which was earlier tenure of 4 years, now it is remaining 2 years. Now it is remaining 2 years. So at what price will I be able to sell it in the market? Tell me the value of the bond in the second year. What's the value of this bond? Value of original 4-year bond, now which is having a maturity of 2 years. The sale value of the bond. How much is it? Which will be 80 into present annual factor at 9% for 2 years, and also 1000 into the present value factor. How much it is? 982. 982.23. Yes, this should be the value in year two. 982.23. Okay. So, what is the total proceeds from each bond Y? First up, the coupon was reinvested, which matures to 87.2 plus 982.23. So each bond is going to provide a total cash flow of 87.2 plus 982.23, which is, and also you will get one more coupon, right? This is year two coupon. Before selling, you will be obviously getting the coupon. So plus 80, that gives us the value as 1149.43. 1149.43. Okay. Okay. So let us say from each bond Y. Okay. Now, what is the total value of all bond X? How many bond X did we invest? We invested in 51.79. This is 51.79 into value of bond X, which is 1166.13. Okay. 1166.13. That's the bond X case, right? Same way, what will be the total value of all bond Y? Total value of all bond Y. That will be, so that's 34.45 multiplied by 982.23. Let's try to get this 51.79 into 1166.13, which is giving us 60,394 and the other side is 34.45 into 982.23, which is 33,837. How much? 982 point.
Hello,
Yeah.
sir, where you have got that value,
Which one?
double one double 6.13.
This one over here, see,
Okay, okay,
because
okay.
bond X will be maturing in first year, right?
Yeah,
And
yeah,
you
right,
get
right, right.
1070 and you reinvest it for another 9%. So this is the value.
Oh, okay, okay.
So here, 34.43. That's, wait, 34.43 into, they're getting 1149.43. 1149.43 into 34.45. Total is 39,598. If you add all of them, 39,598.
Sir, actually for bond X it is 66.30, not 13.
Sorry, 66 point.
30.
Which one?
Bond X, sir.
Bond X is number of bonds.
66.30. Yes, sir.
No, number of bonds is 51.79,
No,
right?
sir, now number of
Huh?
value.
Value is?
Instead of 0.13, it is 0.30, sir. Double one double 6.30.
Okay, okay.
Yeah.
Point
It
three.
becomes 60,403.
60,403. So roughly, if you just translate it, can I say the total maturity is still 1 lakh? So can you see that even after a reduction in YTM from 10% to 9%, we are still able to match our proceeds, which is 1 lakh. This is exactly how the bond immunization functions. So it's like if a bond is maturing early, you can reinvest it at a lower rate. But due to that reduction in the YTM, what you will find is that the sale value of the other bond actually increases because reduction in YTM increases the value of the bond. Okay, fine. So with that, let's just take a break now, guys. And after the break, we will continue with more discussion about. Okay, so immunization is done. We just need to do some other sort of discussions. Okay, let's take a break of around 10 minutes, guys. Before break, we discussed about the concept of bond immunization, wherein we stated that the maturity value of our investment can actually be fixed. Okay, so maturity value of our investment can actually be fixed, wherein the immunization strategy is all about the aspect of investing in a portfolio of bonds uh, with maturity matching your requirement. Okay. Now, let us go for some more questions for practice regarding this. Okay, question number 28, guys. Let's go for question number 28, which is about the commercial paper. Okay, so just look at this question. So, Z Limited issued commercial paper worth 10 crores as per the following details. So, date of issue is given, date of maturity is given, number of days is specified, and also the interest rate of 12.04% is given. So, what was the net amount issued to the company on issue of commercial paper? Now, understand what are these commercial papers. So, let's understand what is this commercial paper. So, commercial paper is worth 10 crores as per the following details. So, when we talk of commercial paper, these are your unsecured promissory notes, right, which are issued by the high rated corporates. Commercial paper these are unsecured promissory notes, which are issued by high rated corporates, issued by high rated corporates, issued by high rated corporates. Okay. And remember, these commercial papers are always issued at discount. They're issued at discount and redeemed at par. These are issued at discount and redeemed at par. Okay, issued at discount and redeemed at par. So basically, the redemption is going to be at 100 rupees, but the issue is going to be at a price below 100. Okay, so here the yield is calculated as face value minus sale value divided by face value minus sale value divided by sale value face value minus sale value divided by sale value into 365 by 91 into 100. Okay. So it is like if you are issuing it at certain sale value, we need to compare it with the face value and then calculate the yield. So in our case, we see that worth 10 crores. This is your face value. We have the face value as 10 crores. Face value is 10 crores. Face value is 10 crores. Interest rate is 12.04%, is your yield. Okay, so face value is 10 crore and yield is 12.04%. 12.04% is the yield. Face value 10 crore and yield is 12.04%. Okay. What was the net amount received by the company on the issue of commercial paper? So we have the face value. We have to calculate the amount of sale value. It's obviously we will be issuing it at a discount. So sale value is lower than the face value. So yield is what? 12.04 is equal to 10 crore minus sale value upon sale value into 365 by 91 into 100. So can you get the value of X over here, solving it? Get the X value. Get the value of X. Yeah, what's the value? 9 crore 70 lakh 87,000. 9 crore 70 lakh 87,000 379. Okay, so that's the redemption thing. Essentially, you are issuing bond as 9 crore 70 lakh, and then you get 10 crore back. So against 9 crore 70 lakh, you get 10 crore back. So the differential is approximately what 29 lakhs. That's your interest income. Okay, so that's about the commercial paper. Now, on the similar lines, we have something in question number 29, guys. Let's look at question 29. Bank A enters into a repo for 14 days with Bank B in 10% Government of India bond 2028. So the bonds which are going to mature in 2028, and the repo rate is 5.65% for 8 crores. Assuming that the clean price, the price that does not have accrued interest, so this is 99.42. So 99.42 is essentially your uh, X interest price. It does not have any accrued interest, right? So 99.42 is the X interest price. Initial margin is 2%. So the margin amount is 2% and the days of accrued interest is 262. You are required to determine the dirty price, repayment at the maturity. Okay. So let's first understand what is this repurchase agreement first up. So what is this repurchase agreement or repo agreement? So repo or the repurchase agreement repo or the repurchase agreement, you will say it is simply a transaction between two banks or between RBI and another bank. So let's say we have RBI on one side and we have a bank on the other side. We have RBI on one side and bank on the other side. So suppose in repurchase agreement, there is initially a sale. There is first a sale transaction. So in the sale transaction, banker gives government securities to RBI. RBI in turn gives the banker a value, let's say 98 rupees. For example, let's say it gives 98 rupees. Right. And this is going to be as on, let's say, day 0. Then on, let's say, day 180, there is going to be a repurchase. So repurchase by bank. The bank actually, the government which was already sold, that is actually repurchased. So this is repurchased by bank. Repurchased by bank, but the rate is now let's say 99 rupees. So the security which was sold by bank for 98 is now being repurchased by the bank at 99. So effectively, the amount of interest that is paid by the bank is how much? What is the amount of what is the amount that is paid by the bank? 1 rupee. So 1 rupee is essentially the interest. Okay. So 1 rupee is the interest. So against you receive that 98 and you pay back 99. That's the interest. So that's your typical repurchase agreement that we have. So now we have to look at a typical question which is targeting this aspect. Let us say, so Bank A enters into repo for 14 days with Bank B in 10% Government of India bonds at 5.65% for 8 crores. So this is for 8 crores, assuming that the clean price does not have accrued interest. It does not have accrued interest. So assuming that the clean price, the price that does not have an accrued interest, is your X interest price. is 99.4. So we have the clean price given to us as 99.42. Clean price is 99.42. I need to get the dirty price, which is basically adding the accrued interest to it. Let us get the accrued interest. Accrued interest will be 10% government. So annually it is 10 rupee and days of accrued interest is 262. So accrued interest is 10 into 262 divided by 360, because you have to consider 360 days in a year. The amount of accrued interest is how much? What is the amount of accrued interest? 10 into 262 by 360, which is 7.27. So accrued interest is 7.27 or 7.28. So 2 decimals. This is 7.28. So total or dirty price is going to be clean price of 99.42 plus accrued interest of 7.28. This gives out to be 106.7. So total or dirty price is 106.7. Total or dirty price is 106.7. Okay. What's the nominal value? Nominal value is 8 crores. Nominal value is 8 crores, right? The nominal value or the face value of the bond is 8 crores. So actually the value of repo, value of repurchase agreement is essentially 8 crores divided by 100 into 106.7. 8 crore into 106.7 divided by 100. That's 8 crore 53 lakh 60,000. Right? That's 8 crore 53 lakh 60,000. That's the total value of repo base. Right? But are we going to get this full value? No, we are not going to get the full value, because the question says there's a margin of 2%. So if the margin is 2%, what will be the amount that we will have in the repo transaction? Principal disbursed under repo will be 8 crore 53 lakh 60,000 into 98%, because 2% is the margin. So leaving that 2%, the rest amount is going to be recovered by us. So 8 crore 53 lakh 60,000 into 98%, which is 8 crore 36 lakh 52,800. 8 crore 36 lakh 52,800. This is the principal amount which is disbursed under repo. Okay, this is the principal which is disbursed under repo. Now, what will be the interest which is payable under repo? Interest payable under repo. So what will be the interest payable? Of course, this principal amount which is given to us into what's the rate? The rate is 5.65% for 14 days. Right? So 5.65% into 5.65% into 14 by 360. So how much is the interest payable under repo? What is the amount of interest payable under repo, guys? Interest that will be paid under repo. This into 5.65% into 14 divided by 360. It's 1 crore 83 lakh 804. So what's the total amount? Total amount payable under repo. Total amount payable under repo going to be 8 crore 36 lakh 52,800 plus 1 lakh 83,804. 8 crore 36 lakh 52,800 plus 1 lakh 83,804. The total repayment that's happening is 8 crore 38 lakh 34,858. The total amount which is payable under repo. Okay, that's the repo transaction.
Sir,
Yeah.
sir, in this 2% commission is there, na? That is between RBI and bank. If it is happened between bank to bank, whether the 2% commission will be there.
No, commission it's not. It's a margin. It's a margin.
But
It's
that
not
is
commission.
for this 14 days transaction, that is too much, na, sir?
No, no, no. This is a margin. This is the difference between the value of the security and the loan that will be given to you. Do you get a loan equal to the value of your property? No, right?
Oh, okay. If we take into consideration that 2%, then
That is
effective
not your
interest rate will be
expense.
more, na?
That is not your expense. That is not your expense. So if the security value is 100, you will get a loan of 98 only. Getting it? And
Sir,
you will anyways get the security back at the end of your repo term.
Sir, okay, you have shown some diagram, na? Like that in the solution also, that which amount will be paid to whom, that from who to please explain, na, sir?
So in this diagram, the payment which is done,
No,
98.
leave the diagram, sir. In the solution, please explain which amount will be paid by whom to whom. First RBI will pay, then bank will pay, na? That.
Yeah. So RBI will pay this amount, principal amount, which is 8,36,52,8.
Okay.
Okay. And the return will be 8,38,000 amount, which is instead of 98, you have this, and instead of 98, you have this.
So this 2 lakhs is the interest amount for bank, sir?
1,83,000 is the interest amount.
That only is the expense for the bank.
Yes.
And RBI income is 1,83,804.
Yes.
Huh?
Yes.
So there is no commission. It is only
No,
margin.
it's not commission. It's just a margin. Margin means you're not getting the full value as a loan of your property value. Like the property which you are
I
keeping
thought
in
it
the
is a
mortgage.
commission and the extra expense, I thought.
That's not expense. Therefore, we did it 98%, right? The value of the government security is 8,53,000. But we are getting 8,36,000 as a loan against it.
So actual interest and effective interest both are same.
Yeah. 183, yes.
5.65 is both actual interest and effective interest.
Yes. Perfect.
That's what I want clarity.
Yes. Correct. Okay. Now, let us do some more questions which are a bit different. But yeah, let's look at question number 16, guys. Read the question for a while. Just give it a read and then we will take it up for discussion.
Sir, here once repo is taken, that that will not be in the name of the bank, na, sir?
No, securities are still in the name of the bank. But
So
the
it can be
RBI is just
accounted
holding.
for SLR, sir? It can be accounted for SLR?
Yes.
So name will not be transferred, eh?
No, name will not be transferred, yes.
Okay.
But if you're looking for whether it's a part of SLR, no, it won't be because you have already mortgaged it with RBI, right?
Oh, yes, sir.
Then how it can be a part of SLR? If you have the securities in your possession, then it will be counted in your SLR.
So SLR securities are not useful for a repo. Only excess of SLR securities
Yes.
are using for a repo.
Correct. Yes.
Huh?
Yes.
Then reverse repo also one explanation, one question, please.
Reverse repo is just opposite. Whatever is repo for RBI, that's reverse repo for the bank.
Oh, okay. One example question.
Reverse repo will
To
be also on the
understand
same
both.
line.
Yes.
So it's like whatever is the repo transaction for the RBI, that is a reverse repo for the banker.
Yes, sir.
The RBI will give you government securities against which you put your money with RBI, and at the end of tenure, RBI will take away the government security, will pay you back the money with interest.
That one question is possible, I must.
We don't have it in this, but question, even if it is question, how is it going to be different? It's just going to be the same thing. It's exactly the same thing, right? If I tell you what will be the rate for reverse repo, entire calculations will be on the same thing.
Okay.
Everything will be same. Just the point of view will change. That instead of interest payable, this will become interest receivable. Principal disbursed will be like principal invested.
Since the reverse repo is a deposit for RBI, it will take more interest. It will
Give you less
take
interest.
more interest.
It will give you less interest. RBI will give you less interest.
Yes, it is a deposit, no, sir.
Yes.
It is borrowing from bank repo. Reverse repo is deposit with bank.
Yes.
So for deposit, lesser interest will come.
Lesser interest. Correct. Yes. Okay. Fine. Let's try to look at this question number 16. Let's have a look at this question 16, guys. Just give it a read, then we'll start discussing it. Okay, so SAM Limited has just paid a dividend of rupees 2 per share and it is expected to grow at 6% per annum after paying dividend. The board declared to take up a project by retaining the next 3 annual dividends. So the board is deciding to retain the next 3 annual dividends. It is expected that this project is of same risk as the existing projects. The result of this project will start coming from the 4th year onward from now. So the dividends will then be 2.5 per share and will grow at 7% per annum. an investor has 1,000 shares in SAM and wants a receipt of at least 2,000 per annum from his investment. So this investor is someone who is looking for a cash receipt of 2,000 every year, so that the market value of share is affected by the decision of the board. Also show as to how the investor can maintain his target receipt from the investment for the first 3 years and improved income thereafter, given the cost of capital is 8%. Okay. So here we need to first calculate the value of the share at present. So first let us say what is the value of share at present. So currently it has paid a dividend of 2 and expected to grow at 6%. We'll simply say dividend or D1 upon KE minus G, where D1 is simply going to be 2 into 1.06 divided by 0.08 minus 0.06, because question says your cost of capital is 8% and it's going to grow at 6%, and the dividend is going to grow at 6%. So what's the value of the share today? Looking at the current pricing, current situation, what's the value of the share? Value of the share at present. How much is it? $106. Okay. Okay. Now, if the board decision is implemented, if board decision is implemented, what is going to be the price of the share in third year? Of course, E4 upon K minus G. Now, what is the fourth year dividend? The dividends will then be 2.5 per share and will grow at 7%. So dividend is 2.5 divided by K is 0.08 and the growth rate is 7%. So what's the price of the share in third year? Price of the share in third year?
So here in dividend growth rate should not be considered, need not be considered. 2.5
No,
into
because
1.07.
2.5 is already given, right? So it's going to grow further. 2.5 is going to grow further. So T4 is anyways 2.5 given to us. The value is coming out to be 250. Okay. Now, since this particular proposition by the board, they're saying that it is expected that the project same risk as existing, the result of this project will start coming up fourth year. But the decision is that after paying the dividend, the board declared to take over project by retaining the next 3 annual dividends. So for the next 3 years, the board is saying that we are not going to pay any dividends. For the next 3 years, the board is saying, the board of directors have decided no dividend will be coming to you in next 3 years. So if that is the case, what will be the price of the share today? price of the share today, it will be simply present value of third year price. So present value of third year price is simply P3 divided by 1 point, or P3 divided by 1 plus K cube. So P3 is what? 250 divided by 1 plus K cube is nothing but 1.08 raised to 3. 250 divided by 1.08 raised to 3. Is 250 divided by 1.08 raised to 3. How much is the present value, guys? Yeah. Yeah, 250 divided by 1.02, how much it is? 198.46. Yes. 198.46. Right. I would also like to have the price of the share in second year and also price of the share in the first year. Now, price of the share in the second year will be just discounting it by a year, which is P3 divided by 1 plus K. So the price is going to be 250 divided by 1.08. And what will be the price of the share in second year? Price of the share in the second year? Yeah, how much? 231.48. And same way, price in the first year will be P2 divided by 1 plus K, which is 231.48 divided by 1.08. Yeah, how much is it? What is P1? P1 is how much? 214.33. 214.33. Okay, 214.33. Fine. Now, the question says that we have an investor, okay, who is holding 1,000 shares and he wants a receipt of at least 2,000 per annum. So how can we ensure that he receives 2,000 per annum for the next 3 years when the company is actually not paying any dividend? So when the company is not paying in dividend, how can this be attained? How can this objective be attained, guys? How can this objective be attained if the company is not going to pay any dividend and our
You have to
investor
sell the
wants,
required number of shares.
sorry,
You have to sell the required number of
sell the
shares.
required number of shares? Yes. So we need to know how many shares he should be selling in the upcoming 3 years so that he keeps on receiving the cash. So we need to know the number of shares to be sold by investor to maintain the targeted cash flow. So in year 1, this will be 2000 divided by year 1 price is what? 214.33. So how many shares? 2000 divided by 214.33, which is 9.33. Which is approximately, of course, 10 shares will be sold. Then in second year, 2000 divided by 231.48. 1000 divided by 231.48. This is 8.64, approximately 9 shares. And then in third year, it will be 2000 divided by 190, no, 250. Divided by 250, we can say 8 shares, so it's going to be, right? Now, the total that we have is going to be what? 27 shares. 27 shares are going to be with him. And what's the shares remaining with him? What is the count of shares remaining after 3 years? Because during these 3 years, we are liquidating these shares, right? So shares which are remaining after 3 years will be 1000 minus 27 is 970. Now we need to check whether we are going to get the dividend as intended after 4 years. So dividend in year 4, dividend in year 4 will be 973 into 2.5. 973 into 2.5, which is 2432.5. Yes, we are anyways achieving the targeted dividend, right? So we are not anyways falling into that lower dividend. Rather, now the dividends are going to be higher than our targeted value of 2000. Okay. So that is done. We have also done quite a few questions. Okay, let's quickly try to solve this question number 20. Just a quick calculation, not a detailed one, because it's a pretty simple question. To calculate the market price of 10% Government of India security currently quoted at 110. But the yield is expected to go up by 1%. So a simple way of understanding is, if the yield is expected to go up by 1%, what is the current yield in this case? What's the current yield in this case? Current yield is 10 upon 110, because 10 is the interest that you're going to get and 110 is the price. So the current yield is simply 10 divided by 110, which is 9.09%. So what will be the revised current yield? Revised current yield will be 10.09%. So what will be the revised price, guys? Revised price will be 10 divided by this new current yield, which is 10 divided by the revised current yield, which is 0.1009. You can get the revised price as 10 divided by 0.1009, which is 99.10, which is obviously as per our expectation thing.
Jagbandhu sir,
Yes.
there is small error. It is not 10 by 10, 0 by, it is 100.
10 by 100.
No, 100 by, I think it should be. Or it should be how you have taken the
No.
10.
10 is the coupon rate, sir.
Okay, coupon rate. Okay.
Yeah. Coupon
Okay.
divided
Then
by
it's
the current yield.
okay. Then it's okay.
Yeah. Coupon divided by current yield. So it is 99.1.
Yeah. No, it's fine.
Yeah. So it's currently quoted at 110. So face value will be 100.
Hmm.
Okay. So second one, guys, a bond with a 7.5% coupon interest, face value 10,000, term to maturity is 2 years. Presently yielding 6%, interest is payable half yearly. Now this is pretty easy. We can get the value of this bond as simply present value of the coupons. But remember, coupons are going to be now half yearly. So what will be the coupon value, guys? Coupon value will be how much? Since the face value is 10,000, on that you take 7.5%, right? So it's 10,000 into 7.5% into half year, because you're going to get coupon for only for every 6 months. So that's into 0.5, which is 375. So coupon is 375. Okay. And we can get the value of the share as 375 multiplied by present value annuity factor at 3%. Remember, the yield is 6%, which is obviously per annum. So we take present value annuity factor at 3% for 4 half years. Also 10,000 into present value factor at 3% for 4 half years. So you can simply carry out this calculation. Remember, this is a half yearly bond. So we are just dividing the yield and coupon by 2. Had it been a quarterly bond, it would have been done by obviously divided by 4. Okay, so you can quickly check the answer for this. This should be equal to 1 second. So the annuity factor will be 1 divided by 1.03. The PV factor is 3.717. That's 375 multiplied by 3.717. And also this 10,000 into the PV factor. It's 1 divided by 1.03, 1.4, 0.884. 0.884. So if you just add them together, 375 into 3.717 is 1393.875, and also this 10,000 multiplied by 0.884. That's 884 plus 1393.875. That's 10,278. 10,278. That's the value of our second. Okay, so with that, we are towards the end of our today's session. So we have discussed the concept of bond immunization initially. Then we also discussed the curvature effect before that, which is the convexity effect. And the most important part was regarding the immunization, wherein we said we were able to achieve our targeted cash flows when we are investing in bonds, which are essentially having a maturity, or which are having the modified Macaulay duration matched to our required maturity. If such bond is not available, we simply invested in a portfolio of bond, which ensured that our proceeds at the end of our targeted period remains constant. Okay. If there are any queries, we'll be happy to address that, or else we can call it a day.
Okay, I think Jagbandhu
No
sir, there is
queries.
no more queries. And student, now with today's class, the topic that has been covered is basically started with I think, sir, you have started with the bond is a convexity effect, if
Convexity,
I'm not
yes,
wrong.
yes.
And when you are saying convexity effect, two terms you have used very frequently, error and concave effect. Okay, of course, in the beginning, I was thinking what are these terms, but in the last you have linked it to the very beautifully to the convexity effect. So student, convexity effect is very important. And another important point in today's class, if you have observed that when we talk about the security valuation of any equity share, the scope of calculation, or we can say the variety of calculation, is bit limited, like calculation of free cash flow to the equity EPS, and then we are calculating using the CAPM model to calculate the return, or we can say value of the equity. But when we talk about the bond valuation, when bond is a kind of a more dynamic, in my view, the bond is more dynamic because of course equity is also affected by the market, but I think bond is also impacted by market as well as other factors also. The interest rate yield, market yield is one of the very determinant factor. Of course, in equity, the Sensex is a determined factor, but generally, in what happens whenever we talk about the equity, equities, all reflections of sentiments of the market are reflected in their price. Price goes up, price goes down by as per the Sensex. But when we talk about the yield, when we talk about the bond, of course, bond calculations require that much calculation. Why? Because bonds are not that much traded frequently. Had they been traded so much frequently, then certainly that the level of calculation may be little bit reduced.
So one clarification.
Mm-hmm.
So one clarification, sir.
Yeah, please tell.
Sir, whenever this market price P is calculated, P is equal to T by K minus G. Sometimes we are giving D into 1 plus G, sometimes we are giving D by K minus G. How we can differentiate both formulas, that please explain.
That is, you are talking about P is equal to D1 upon KE minus G. You want to say like this?
D0 by KE minus G. Both differentiation. When we have to take D0, when we have to take D into 1 plus G.
Yeah. Okay. Your question is very valid question. Student, please note that. Very good question. Now, please note one thing. Whenever we talk about the equity valuation, generally we give the clarification, and even I receive mail. I think every week I receive mail on this. But there is a very simple logic. Now, if dividend expected has been given, so you consider it as a D1. If dividend paid has been given in the question, yeah, then you consider it as a D0, then multiply it with the 1 plus G. But if simple dividend word has been given, then confusion comes. In that case, student, do one thing. You assume anyway, take it anyway. Both of the alternative will be accepted in examination. You not to worry about the same. Unless and until there is any other hint is there. Is there any other hint is there that dividend is what expected, or it has been paid for the last year, then this assumption will not be valid. But if simple dividend word has been used and there are no other hint, then you can consider it anyway. Both answer, you will get full marks for each answer. And you know to give both answer. Alternative means only one answer you have to give. Okay, is it clear now?
Yes, sir.
Okay.
So both way we can give result.
No,
we
you
can give
only one way. Only one way. There is, you're not to give the.
No. We can assume anyway.
Anyway. If no hint is given.
Into 1 plus G or without 1 plus G.
Yeah, of course, because there is anyone can consider them the way he likes, na.
Okay.
Okay.
But that is a confusion, sir. That's what.
No problem. You are free to ask any type of concern. Okay. So I was talking about the so bond is basically more dynamic, and especially when we talk about the bond is a kind of a thing that generally when the sir has covered the topic of bond immunization. So in this topic of immunization, there was one very beautiful thing. It is generally used for the any fixed income, fixed liabilities for future of time. So that's why generally pension fund, gratuity fund use this fund, this bond value very frequently, because of course they are likely to be affected by the interest rate, but the variation is not that much. as in case of a market, because if on the go by the market, then market sentiments are very volatile. Market is more, equity market are more volatile. Of course, interest rate are also volatile, but the degree of their volatility is not that much as of the equity market. So Jagbandhu sir, I think you will continue this topic in the next class as well.
Yeah, maybe 1 or 1.5 hours will take,
Okay.
because I just have to look at the bond refunding and few other cases, and
Okay.
then this will be done.
Okay, there's an
After that, we'll start with portfolio.
Okay. So student, with this, I think in the next class, this topic will be over. So as a practice, if you have any query, you can contact me over the telephone at this number, or you can send us the email if any point come to your mind later on, because sometimes what happens, any query may not come at this moment of time, but later on, if any query rise after during your revision process, so you are free to contact us. Thank you very much for patiently listening and making this session very interactive. And thank you, Jagbandhu sir, for sparing your precious time, and enlightening the student on this topic. And thank you very much once again, and have a nice day. Thank you. Yeah, you can end.